Have you ever looked at a stock and thought, is this really worth the price? You're not alone. Most of us have bought stocks based on a tip, a trend, or just because everyone was talking about it. But here's the thing. What if you could know the actual value of a stock? Not just what the market says it's worth today, but what it's really worth, based on how much money it could make in the future. That's exactly what this video is about. And I promise, I'll keep it simple, clear, and super useful. So what exactly is DCF? It stands for discounted cash flow. I know, it sounds complicated. But the idea is actually pretty simple. Let's say you're planning to buy a machine, and this machine is going to earn you money, not just today, but every year for the next 10 years. How much would you pay for that machine today? That's what DCF helps you figure out. It looks at the money you expect to make in the future, and then brings it back to today's value, using something called a discount rate. In short, DCF helps you find the present value of future cash flows, and that, right there, is how you estimate what something is really worth. In the stock market, that machine is a company. So we use DCF to figure out what a company's stock is truly worth, based on how much cash it can generate over time. All right, so how do we actually calculate DCF? Let me walk you through the key ingredients. Don't worry, we'll keep it simple. First, we estimate something called free cash flow, or FCF. That's basically the money a company has left. After covering its basic expenses and investments, it's like profit, but cleaner, more real. Then we project those cash flows over the next few years, usually 5 to 10. Before we can start projecting cash flows, we need a few simple ingredients to set up the valuation. First, the current market price. This tells us how much the stock is trading for right now. Second, the free cash flow from last year. This is the cash the company generated after covering all expenses and investments. Third, the growth rate. We usually take the 5-year average. For stable companies, this is often between 5 to 10%. For faster growing businesses, it might be higher. Fourth, the terminal growth rate. This is the modest growth we expect after the forecast period, typically around 2 to 3% to stay realistic. Fifth, the discount rate. This reflects the expected return for the risk we're taking, usually between 7 and 10%, depending on the company's stability. Next, the net cash. That's the cash the company holds, minus its debts. A company with a strong cash position adds extra value. And finally, the number of shares outstanding. This helps us calculate the final intrinsic value per share. Just 7 simple inputs. With these numbers, we can build a complete DCF model and figure out what the company is truly worth. Here's how the discounted cash flow process works, step by step. We start with the company's current free cash flow. In this example, that's $100 billion. To forecast the future, we grow that cash flow by the expected growth rate, compounding it over each year. The formula looks like this. Future cash flow in year T equals current cash flow times 1 plus growth rate, raised to the power of T. This gives us the projected free cash flow for each future year. But future money isn't worth the same as money today. So next, we discount each year's future cash flow to bring it back to its present value. The formula here is discounted cash flow in year T equals future cash flow divided by 1 plus discount rate, raised to the power of T. Using this method, in year 1, our projected cash flow grows to $110 billion, and its discounted value is about $102 billion today. In year 2, the future cash flow rises to $121 billion, but when we discount it back, it's worth just about $104 billion today. And so on, year after year, for 5 years. Each year's future cash flow is projected, then discounted, and then all the discounted cash flows are summed up to calculate the company's total intrinsic value. Now let's see how we actually calculate the terminal value. Terminal value is based on the free cash flow at the end of our forecast period, which in this case is year 5. The formula looks like this. Terminal value equals the free cash flow at year 5 times 1 plus the terminal growth rate divided by the discount rate minus the terminal growth rate. In our example, we take the year 5 free cash flow, which is $161.05 billion, multiply it by 1 plus the terminal growth rate of 3%, and then divide by the discount rate minus the terminal growth rate. This gives us a terminal value of approximately $3,317.65 billion. But that's a value projected 5 years into the future, so we still need to discount it back to today. We do that by dividing the terminal value by 1 plus the discount rate raised to the 5th power. In this case, we divide 3,317.65 billion by 1.08 raised to the 5th. This gives us a discounted terminal value of about $2,257.92 billion. This discounted terminal value will later be added to the sum of the discounted cash flows from the first 5 years to find the company's total intrinsic value today. Now that we have all the pieces, let's bring everything together. First, we calculate the total company value. We do this by adding up the discounted cash flows for the next 5 years, then adding the discounted terminal value, and finally adding the company's net cash. That's cash minus debt. The formula looks like this. Total company value equals sum of discounted free cash flows plus discounted terminal value plus net cash. In our example, we add the 5 discounted cash flows plus the discounted terminal value of $2,257.92 billion plus $50 billion of net cash. This gives us a total company value of approximately $2,836.41 billion. But we're not done yet. We want to know the value per share. So now, we divide the total company value by the total number of shares outstanding. In our example, 2,836.41 billion divided by 16.5 billion shares gives us an intrinsic value of around $171.90 per share. And that's it. We now have an estimate of what each share is truly worth based on future cash flows, not just market hype. Now here's the best part. You don't need to do any of these complex calculations by hand. All the heavy lifting is already built into our Stock Valuation Kit template. All you have to do is enter a few simple inputs: the company name and ticker symbol, the current market price, last year's free cash flow, the expected growth rate over the next 5 years, the terminal growth rate after the forecast period, the discount rate you want to use, the company's net cash position, and the number of shares outstanding. That's it. The template automatically calculates the projected future cash flows, the discounted cash flows, the terminal value, and the final intrinsic value per share. It even gives you a quick verdict, telling you whether the stock appears overvalued or undervalued based on your assumptions. In this example, the intrinsic value per share is about $171.90. Since the current market price is $180, the stock appears overvalued by around 5%. Simple, clear, and data-driven, just the way investing decisions should be. If you're someone who likes to see the full working behind the scenes, we've got you covered too. Our template also shows you the complete intermediate calculations. You can see the projected free cash flows for each of the next 5 years, the discount factors applied to each year, and the final discounted cash flows, year by year. We also display the calculated terminal value, the discounted terminal value, and the total company value, all broken down clearly and transparently. This way, you can cross-check the numbers, understand how the final intrinsic value was derived, and feel fully confident in your analysis. Because smart investing starts with clear, transparent information. And if you're a visual thinker, we've got something for you too. Our template automatically generates a clean, easy-to-read chart that shows the difference between the projected free cash flows and their discounted values over the next 5 years. In this chart, the blue bars represent the projected free cash flows for each year before adjusting for the time value of money. The red bars show the discounted free cash flows after accounting for the discount rate. You can clearly see how future cash flows lose value when brought back to today's terms. This simple visual makes it much easier to understand how the discounting process affects the final valuation. So whether you prefer numbers or visuals, this template gives you the best of both worlds. Thanks for watching. I hope you now have a clearer understanding of how discounted cash flow works and how easy it can be to estimate a stock's true value when you have the right tools. If you found this template helpful, you can download it from the link in the description below. And if you'd like more practical tools, tutorials, and investing insights, don't forget to hit that subscribe button. We're just getting started, and there's a lot more value coming your way. See you in the next one.